Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Chuani Good Night. Today is Friday, October 17th. I'm analyst Jiang Jida. Before we start, remember to like, subscribe, and share. If you have investment questions, feel free to leave a comment. If I don't have time to answer today, we'll respond next week, though I won't be hosting the live stream then. What a wonderful Friday. There are a lot of major events today, international news that I want to share with everyone. Just as many of you asked before class, the biggest news today is that 2 American banks are facing some risks of bad debts. This has caused significant volatility in the US stock market before the opening today. With these risks and this kind of turbulence, how should we be observing the situation? Tonight's Good Evening program is meaningful, as we'll be analyzing these related topics together. Hello everyone, good evening to Hujuanjuan, my Daisy, and also Xiaomeov. And who else is here? Good evening to Wan K. Kukuli, and hello to Kai Huifang, Luis Young, and Ms. Shea. Good evening to Melissa Chen as well. Okay, let's get into today's investment world. The first investment focus to observe is that officials are still making statements. As we approach the end of October and the upcoming Federal Reserve policy decision, officials are gradually entering what they call the quiet period. So, before this quiet period, officials are taking the opportunity to repeatedly express their positions on monetary policy. Most of the officials, whether they have voting rights or not, are leaning more toward dovish viewpoints, meaning they support cutting interest rates once or twice, whether in October or December. Today, I'll also share with everyone a few related officials who have brought up some important dovish arguments. There are different interpretations regarding whether to cut rates once or twice. Another important topic is the cockroach theory. Is there just one cockroach, or is there a whole group? Anyone who manages a household knows that there is never just one cockroach, especially when it comes to cockroaches. If one shows up in the kitchen, where there's food, that's their favorite spot. So, whenever you're cleaning the house, especially the kitchen, if you spot one cockroach, it usually means there's more than one. When you lift up the newspaper or move the cabinets, you'll find out. They'll just scurry out, so usually you'll see 5 or 6 cockroaches coming out together. So cockroaches are never just one, they come in groups. But there are many ways to deal with cockroaches, and it's not that hard. Right now, the US stock market, the US economy, and issues like bank loans, credit, or bankruptcies are just like the cockroach theory. The cockroach analogy was actually brought up recently by JP Morgan Chase CEO Jamie Dimon. He said that when you see one cockroach, it usually means there's more than one, and a whole group might show up. Here, the cockroaches he's referring to are the issues that have been popping up one after another recently, like the bankruptcy of some car companies or banks defaulting on loans. These kinds of news stories will, of course, have a short-term impact on the bullish momentum of the US stock market, they definitely will. But after talking about the impact, I'll explain to everyone in a bit how the current situation compares to the Silicon Valley Bank crisis in 2023 or the Lehman Brothers collapse in 2008, what similarities or differences there are, and how the government usually responds to these kinds of problems. So, is it just one cockroach or a whole bunch? I'll explain all of that to everyone in a moment. Besides that, on another note, Oracle just held its so-called AI World Conference over the past 4 days. They also addressed market concerns that their cloud computing and related businesses might only have a gross margin as low as 10% to 45%. But this time, at the AI conference, they specifically clarified that for orders related to AI models and services, under similar circumstances, the gross margin could reach as high as 35%. As for Oracle's development in AI, there are actually many companies that are collaborating with Oracle. Regarding Oracle's progress in AI, the trends in AI, and even the status of their orders, what exactly did they talk about at this AI conference? Yesterday, during trading hours, you could see that Oracle's stock suddenly spiked, but unfortunately, after a strong rally, it lost momentum and couldn't keep going. Plus, today, the US stock market might see a significant correction in the futures market. So for these AI-related concept stocks, it's pretty common lately to see them pull back and correct after big gains. But while they're correcting, you should pay attention to a few things. Which AI stocks are really worth watching? Which ones might just be all hype and empty promises? You need to be a bit cautious about those. Now, as for Meta, what are the pros and cons for them? Of course, Meta is also a major player in AI. Today, for example, one of their partners, the world's largest eyewear company, released its financial report, and the results were generally better than expected. However, there was also some negative news. A former executive from Meta has brought up the so-called AI bubble theory. So, how should we look at both the positive and negative sides of this? Tonight on our show, we'll break it all down for you. Alright, first let's take a look at some economic data. Good evening to everyone, and good evening to SY as well. Good evening, everyone. Alright, first let's take a look at this afternoon. This afternoon, the Eurozone September CPI monthly and yearly rates were released. As for both the monthly and yearly figures, in fact, they were the same as the previous values and the forecasts. The monthly rate came in at 0.1%, and the yearly rate was just 2.2%. Overall, you can see that inflation in the Eurozone is currently under control and continues to cool down. Of course, this is more favorable for the European Central Bank to continue with interest rate cuts. So, looking at central banks around the world, except for the Bank of Japan, which is actively trying to move toward raising rates, other countries are all trying to find ways to do what? They're looking for ways to cut interest rates to stimulate the economy, and also to boost economic activity and even the stock market. So, when it comes to the Eurozone, there's no need to be overly worried about inflation. At present, inflation is not a major factor affecting the Eurozone's monetary policy, at least not anymore, because inflation has now dropped to around 2%, give or take. On the other hand, what the US needs to worry about is the impact of tariffs. Each round of debt and inflation is a bit harder to keep under control, but it's not to the point of being completely out of control. So, I'll also add some supplementary information for everyone about the correlation between the euro and this unit cost. In addition, tonight there may be a few fun data releases. Maybe they'll be announced at 8:30, or maybe they won't be announced at all. We don't know. If they are released, we'll go over them together. Of course, before they're released, let's preview some of the related data. First, the number of new housing starts and building permits in the US for September. The previous value for new housing starts was 1.307 million units. The forecast is 1.32 million units. As for the total number of building permits, the previous value was 1.33 million units, and the forecast is a slight increase to 1.343 million units. In principle, this data was originally scheduled to be released tonight at 8:30, but due to the US government shutdown. So we can see that a lot of recent data is pending and can't be released. But whether it's released or not doesn't really matter, because yesterday, on our Good Night program, we already analyzed the so-called Federal Reserve's Economic Conditions Report, which was released early yesterday morning. That included the main economic growth, inflation, price levels, household spending, consumer spending, and even investment spending in each region. We've already explained all of that to everyone in detail. Overall, looking at the big picture, the current job market is relatively sluggish. Although inflation has risen slightly, it's not out of control yet. And with the job market cooling off and even showing some weakness, this situation is actually more favorable for the Federal Reserve as we approach the end of October. It could even lead to a dovish move on monetary policy, such as a rate cut, by mid-December. So even though a lot of recent economic data hasn't been released yet, we can still see from other indicators that Federal Reserve officials are leaning more toward a dovish rate cut. Keep an eye on that. Also, for September in the US, the monthly import price data is still pending. Maybe it will be released at 8:30 as well. The previous figure was 0.3, and the forecast is 0.1. So, for this data, if import prices don't spike significantly, there's no need to be overly concerned about inflation. Lastly, there's the US industrial production monthly rate for September. The previous value was 0.1%, and the forecast is 0. This data is generally viewed as neutral and isn't particularly important, so no need to worry. Alright, good evening Grace, Leia. US stock futures are slowly climbing up. This morning, the market dropped quite a bit, but now it's coming back up. Anyway, whether it's dropping or rising, both the decline and the rebound have significant factors behind them. What are those factors? The cockroach theory is at play here. Alright, I'll explain it to everyone in a bit. Now, let's look at the official statements, specifically Waller and Liss. Waller Liss is currently a very important member of the Federal Reserve Board. Of course, he's also one of the more popular candidates for the next Fed chair. People like Waller, Bowman, and even economic advisor Hassett or former board member Walsh, these are all key names on the candidate list. Now, Waller Liss is considered more dovish, which is why he's such an important candidate. As for Waller, he stated that he advocates gradual rate cuts. And he brought up an important point. He believes the neutral interest rate should currently be 100 to 125 basis points lower than where it is now. What does that mean? The so-called neutral rate refers to the level of interest rates where. What does this interest rate level represent? It's a rate that won't overheat the economy, nor push it into recession. This is the neutral interest rate. It won't overheat the economy, nor cause a downturn. It's a very moderate, neutral rate. You can think of it as being right in the middle, very balanced. It's an interest rate level that represents stability in the economy, a kind of steady state. Now, it's believed that this so-called neutral interest rate should be about 100 to 125 basis points lower than the current rate. In other words, if the current rate is around 4 to 4.25, then 100 basis points would be 1%, or 100 basis points, and 125 basis points would be 1.25%. So, simply put, he thinks the current neutral interest rate should be at least 3%, which makes sense. Basically, what he means is that the current interest rate level is too high. The current interest rates are too high. He believes a safer, more moderate level would be around 3%. That's basically the idea. So, he supports cutting interest rates. In addition, he thinks that government shutdowns create a lot of policy uncertainty. As for people like Kashkari, he said that the current job market is slowing down, and it's expected that inflation in the service sector will decrease, while inflation in goods will spill over. This is just a quick overview. Basically, he thinks the impact of tariffs will last longer than expected. In other words, he doesn't see inflation in the service sector as a problem. The bigger issue right now is inflation in goods, because goods are affected by tariffs. So, he believes that the inflation in goods might gradually spill over and start affecting the supply of materials, the economy, or prices in general, spreading out little by little. But there's no need to worry about inflation in the service sector, since that doesn't have much of an impact. However, he thinks we should pay a bit more attention to the inflation in goods caused by tariffs. Now, there's another committee member named Barkin. Good evening to Barkin, and good evening to everyone else as well. So, this other member, Barkin, what did he say? Consumer spending is still relatively stable right now, but many households, especially those with low to middle incomes, are becoming more cautious about their spending. They're not as willing to spend money because they feel like prices are starting to creep up. So, of course, for people with low to middle incomes, people like that, they have to make every penny count, so they're even more careful with their spending, which is totally understandable. Also, Mester is still maintaining her stance on rate cuts, whether it's a cut of 0.25% or 0.5%, but overall, looking at the big picture, he basically thinks there should be a rate cut in October and another one in December. That's about it. So, for the whole month of October this year, it's a period without much economic data, making it easy to be in the dark and hard to make decisions on monetary policy. Even so, when decisions are made, we can see that most officials are leaning dovish. Their stance is generally dovish. Since that's the case, it will, to some extent, provide support for the stock market and the economy. So just remember this concept and this stance. That's enough. So even though a lot of economic data hasn't been released, the officials are basically telling you that their stance is relatively dovish, and that's enough, that's good enough. Now, let's take a look at something more important that's happened recently, these things that have happened in the past couple of days. Not only did they cause gold to surge all the way to 4,300, which is really scary and shocking, but they also made the stock market and futures extremely volatile, with huge swings. That's what's going on. Good night to the staff. What happened exactly? Well, banks have run into issues with lending and investments. Basically, they gave out loans, and then those loans turned out to be fraudulent. To put it simply, someone didn't pay the money back. Which two banks are we talking about? They're both regional banks. One is called ZN Bank, and the other is Western United Bank. So, ZN Bank, if I remember correctly, was actually founded by a Christian. It's been around for a really long time, over 100 years, since the 1800s or something like that. So, these two banks, ZN Bank and Western United Bank, what they did was issue loans, specifically loans for commercial mortgage investments. So this fund for non-performing commercial mortgage loans was actually scammed during a transaction, which basically means the money couldn't be recovered. To put it simply, they lent out the money but couldn't get it back, so it turned into bad debt. Now, the ZN Bank subsidiary set aside a $50 million impairment for this, and similarly, Western United also had to make provisions for this kind of bad debt impairment situation. So, this kind of thing is starting to make everyone a bit worried, because right now the US index is at a historic high. And as we said before, when it's at a historic high, not a historic low, but a high, any little disturbance, any strange news or odd reason, or even just AI valuations being too high, revenues not coming in, and so on. Basically, you can imagine that whenever the stock market is about to drop, there will be all sorts of reasons and excuses. Then, even the slightest disturbance will make everyone jumpy, like startled birds. This is normal, totally normal. So, even things like today's news about banks reducing their lending and taking losses will get blown out of proportion. Blown out of proportion to what? Blown up to the scale of the Silicon Valley Bank collapse in 2023 or the Lehman Brothers collapse in 2008. Let me tell you, besides this new bank, there are two other companies that have also come in and gone bankrupt. Which two companies? One is The leading company in used car loans is called Tricolor Holdings. Some people translate it into Chinese as Sankai Holdings Group. And the other company, an auto parts manufacturer, is called Facebrand. Both of these companies have declared bankruptcy. So, why did these companies go bankrupt? Why did these banks experience loan impairments? Of course, there are reasons. One of them is definitely the extremely high interest rates. Let me put it this way, let's do a quick explainer. Whether it was in 2008, everyone should know about Lehman Brothers. That incident was already a long time ago, probably more than 10 or even 20 years ago. Basically, it was all about bad debt, right? These NBS kept getting issued, and later on, the interest rates were too high, so some people just could not pay back the money. Mortgage rates were too high, and people bought houses couldn't keep up, so they couldn't pay their homes. These are considered bad debts. These borrowers can't pay back. The people buying houses, these are subprime mortgages, meaning the quality of these loans isn't good. So when you lend to them, after you give these people the loans, there's already a higher risk of default. After lending to them, you then take these loans and package them into all sorts of things like MBS, mortgage-backed securities, bad debt bonds, and loan assets, and sell them to lots and lots of investors. A lot of banks sell to each other and hold shares in each other, so when you sell to these people, you're taking on a certain amount of risk. Why? Because that's exactly how Lehman Brothers collapsed back then. It was all about bad bonds, bad asset-backed bonds. You keep repackaging them and selling them to others, and then, at the very top, the original source. These borrowers already had credit problems to begin with. That's why it's called subprime mortgages. They couldn't pay back the money, and it was hard for them to get loans. Their credit situation was already pretty bad. But the banks insisted on lending them money anyway, so they used it to buy houses, right? They bought the houses, but in the end, interest rates kept rising and rising. When the rates went up so much that they couldn't even pay the interest anymore, they couldn't keep up with the mortgage. So they just threw up their hands and said, I can't pay it back, let it collapse if it has to. Exactly, high interest rates cause bad loans to collapse. When they went under, many banks were dragged down because everything was connected. This led to the collapse of Lehman Brothers in 2008, and also places like Bear Stearns. And then there was Lehman Brothers, and, also AIG, that big American group, and even Nanshan Group, they all went under, a lot of them did. Basically, the banks were bailing each other out, especially with government funds stepping in to help. I remember back then, the government spent something like $85 billion to bail out AIG. As for Lehman, they didn't bail it out, they just let it collapse. Anyway, that was a long, long time ago, but at the time, the whole world was in chaos, and the stock markets everywhere were crashing. Then in 2023, the issue wasn't Lehman Brothers anymore. In 2023, something else happened, something people are probably more familiar with. In the past couple of years, Silicon Valley Bank. Why did Silicon Valley Bank collapse? Why did a bank go under? Actually, it wasn't as dramatic as what happened with Lehman Brothers. Why did Silicon Valley Bank fail? I think there were some human factors involved, as well as poor asset management and some weaknesses in the regulatory system. These led to a bank run and eventually bankruptcy. As for what happened with Silicon Valley Bank, in fact, it was the 16th largest bank in the United States. Being the 16th largest bank, it's not exactly big, but it's not small either. However, the nature of its business is quite unique. Silicon Valley Bank, as the name suggests, was originally focused on lending. Why is it called Silicon Valley Bank? Because, as we all know, Silicon Valley in the US is home to many high-tech industries, a lot of startups, and it's also a favorite spot for venture capitalists who love to invest in new tech companies. That's why it's called Silicon Valley Bank. And true to its name, Silicon Valley Bank specializes in lending to whom? It lends to these startups, to biotech companies, and to those emerging, promising companies that have the potential to grow and attract venture capital. That's who they give loans to. When interest rates are low, there's no problem at all. With low interest rates, everyone wants to borrow money, and the cost for borrowers is also low. When you lend money out, the interest on those loans is also relatively low. So naturally, things develop in a positive direction. Low interest rates stimulate the economy and the stock market alike. But in 2023, interest rates were extremely high, just kept going up and up and up. In the end, because the interest rates were so high, what happened to these startups? They realized, wow, with rates this high, before, I could borrow from the bank at just 1%. Now the interest rate has shot up to 5%. Wow, that means my costs are 5 times higher, so I just won't borrow anymore. Because I'm a startup, right? I don't have much capital to begin with, and my company is still in the early stages, still growing, burning through cash really fast. At 1% interest, I borrow. At 5%, I can't, so I don't. This reduces bank income. First, that's it. Second, another problem comes up. After he stops borrowing, what happens? He doesn't want to take out loans, or maybe he doesn't want to raise cash by issuing bonds or stocks to invest the money. He just doesn't want to borrow. All he wants is to get his money back from the bank. Key point: companies, young entrepreneurial industries, or even regular people realize I want to take my money out and use it. I want to use my own money. When they try to do that, a big problem arises. What problem? So what about Silicon Valley Bank? At first, everything was fine because they were lending to these startup companies. But as interest rates kept rising, here's what happened. People had deposited their money in the bank, right? So the bank had a lot of money. With all that money, the bank needed to invest it. They could either invest in stocks or in something else, like bonds. At that time, Silicon Valley Bank did something. They probably didn't manage their risk well, and they took most of their money and invested it in long-term bonds. They invested in long-term bonds, and as we know, the level of interest rates, or yields, moves in the opposite direction of bond prices. For example, recently, the yield on 10-year bonds has been dropping, which means interest rates are falling, so bond prices are going up. But when yields go up, then prices will fall. Back in 2023, interest rates kept rising, so as rates went up, bond yields also rose accordingly. When interest rates go up, what happens to bond prices? They fall. And it just so happened that Silicon Valley Bank, at that time, the bonds they bought were all long-term bonds, and long-term bonds are interesting. Long-term bonds tend to be even more sensitive to interest rate fluctuations. In other words, when interest rates go up, bond prices go down. The price drop of long-term bonds will be greater than that of short-term bonds, and the fluctuations will be bigger. And since Silicon Valley Bank happened to buy a lot of long-term bonds, when interest rates rose, the value of those long-term bonds dropped even more. So with all this back and forth, it was game over. Why? Because on their books, it turned into a mess. They had bought a lot of long-term bonds, and since interest rates were rising, the unrealized losses from the drop in long-term bond prices were huge. But in this situation, what did the public and businesses want? They wanted to get their money back. They wanted to get their money back because they were afraid they wouldn't be able to, so they tried to withdraw their money. As a result, the bank didn't have enough deposits, so what did they have to do? They had no choice but to sell those long-term bonds at a big loss in order to turn them into cash to return to the public. But as the situation snowballed, it turned into a bank run by both the public and businesses. Everyone wanted to get their money out of Silicon Valley Bank. But did it have cash? No, so they collapsed. So at the time, there were a lot of problems with how they managed their assets and investment portfolio. On top of that, interest rates were very high, so when things started to fall apart, they really collapsed. That's why Silicon Valley Bank went bankrupt in 2023. Later on, of course, it was acquired by First Citizens Bank, and the government spent a lot of money as well. I remember the FDIC, the Federal Deposit Insurance Corporation, also put up money to help. So looking at the whole picture, the backgrounds are different. One was the subprime mortgage crisis, MBS, and the other was this situation. It was some issues with long-term bonds, and because their asset investment strategy wasn't well planned, it led to a bank run, which caused the collapse of Silicon Valley Bank. So the situations in 2008 and 2023 are different. Now, as for whether the CN Bank and Western Alliance Bank will end up like Lehman Brothers or Silicon Valley Bank, whether the situation will be that big or that similar, at the moment, it doesn't seem like it. It looks more like isolated cases of individual banks failing. It's kind of like individual companies, maybe they just can't pay back the money. Or maybe they're using fraudulent methods or some strange tactics that end up turning the loans into bad debt. So it's more like isolated cases, not like the bank run at Silicon Valley Bank, where things escalated into such a big storm. I even remember that back in 2023, it wasn't just Silicon Valley Bank that collapsed. There were 2 or 3 other banks that were also affected, though Silicon Valley Bank was the most well-known. But this time, that's not the case. This time, it hasn't happened like that. This time, with this cockroach incident, it's basically just these 2 banks involved, but it's more of an isolated case. It's a case of bad debt within individual banks coming to light, but it hasn't been blown up to the point where the public is panicking and causing a bank run. That hasn't happened. So to put it simply, the incidents with these 2 banks this time aren't as serious as what happened in 2008 or 2023. That's the first thing. It's just that right now, the stock market is at a historic high, so when it's at a record high, even the slightest disturbance makes everyone want to run for the exits. Some people run first, because if you don't, things might get bad. If you don't run, but I run first, it turns into the situation. Now, as for the bankruptcy of these 2 leading car companies, I think that's something to pay attention to, because it's definitely related to interest rates. It's related to high interest rates. So we can only say that whether it's the banks taking losses from defaults, or the bankruptcy of those two correlated companies, for now, things are still not out of control. It's not out of control yet, we just need to pay a bit more attention to these issues. Even if things do get out of control, I think it will be similar to what happened in 2008 or 2023, the government will still step in to help. The government is still rescuing, and why? Because there's an election next year. That's one reason. That's a very big reason. Okay, another issue is Wells Fargo. Wells Fargo said that right now, it looks like these incidents, whether it's banks or car company bankruptcies, are more like isolated cases. But if there are too many isolated cases, people will start looking for more problems to support their concerns. In the end, is this really just a few isolated incidents? Or are there actually many underlying reasons? And then there's that cockroach theory mentioned by Jamie Dimon, the CEO of JP Morgan Chase. The cockroach theory basically says that if you see one cockroach, there's probably not just one, there's likely a whole bunch hiding where you can't see them. What he means is that these two banks might have some bad debts, and there could be a lot more hidden underneath. All companies have these problems, they just haven't come to light. I truly believe there might be issues that haven't surfaced, it's a matter of when. For now, everything might seem fine, but we don't know when something might blow up. Of course, he was just talking about the cockroach theory, thankfully, only cockroaches. It's a good thing they're talking about the cockroach theory and not about rats, because rats are a much bigger problem. If you've ever had a rat infestation at home, you'll know that if you see one rat, it's basically never just one. Rats always come in groups. Usually, if there's one rat, there's a whole nest of them, okay? Because rats have a strong sense of family. Their family relationships are really, really close. Rat dad, rat mom, and rat kids all eat together and chat together. So if you see one rat, it basically means there's a big rat family somewhere. But cockroaches are different. They show up in 2s, 3s, or 5s, scattered all over the place. That's why rat problems are harder to deal with, and the damage rats cause is also much greater. So why doesn't Damon talk about rats? He talks about cockroaches because they're relatively easy to deal with. If you see one, just kill it on the spot, right? Grab a slipper, tissue, or newspaper and smack it. It's done for, right? If you see a bunch, just use pesticide. Grab some spray, give them a few squirts, and that's it. So what does this mean when applied to the financial industry and the current financial situation? If these banks or these bankrupt car companies are like cockroaches, then it's simple, you just write off the bad debts. Handle them as bad debts, set aside provisions for them, and the banks can deal with it easily. There won't be a bank run, and you won't see the bank's investment portfolio thrown into chaos, or issues with long-term bonds, and so on. If there's a big crash, you need to quickly deal with impairment losses. But right now, there's no need, so it's just like cockroaches. If there are many, the government will step in to help. How does the government help? Not by spraying insecticide. What does the government's insecticide represent? Why would the government throw money at it? If the government has money, what will it do? It will have big financial groups or government funds keep bailing out these banks that are about to go bankrupt, so that regular people don't end up unable to get their money back. Okay, so when it comes to banks, according to Dimon, he's talking about cockroaches. But if in the future you hear a CEO say that the current crisis or event is not just about cockroaches, but something even worse, maybe they start talking about locusts or rats or something like that, then you need to be careful, because that means the situation could be more serious. So there's still a difference between cockroaches and rats, you know. Also, the president of Goldman Sachs mentioned something related. He said that in the next 10 years, high-yield bonds, leveraged loans, and private credit, these add up to about $5 trillion US. $5 trillion means everything is interconnected, high yields, leverage, and so on. In private markets, if one link in the chain collapses or someone can't pay their debt, it could trigger a domino effect. If you can't pay, this has already been repackaged and sold to someone else, repackaged and sold. If money can't be paid, it just keeps getting passed along. If one party can't get their money, then the next party can't get their money either. So there's always a next party. If the previous one collapses, the next one loses money. It's a chain reaction, one link after another. That's why he says this $5 trillion chain effect could be quite concerning if someone defaults. So overall, I think at this point you can treat this as an isolated case. It's not yet something that should be blown up into a very, very serious issue. Oh, besides the first point we mentioned, the cockroach theory, not the rat theory, because with rats, it's a whole nest and much harder to deal with. The second point is that next year is an important election year. There's an election next year. There's an election next year. Everyone needs to remember, there's an election next year. So in the market, or the people in charge of the country, they don't want any trouble. If they don't want trouble, what will they do? Either the government will bail out these banks, these bankrupt companies, or something very simple will happen. Back in 2008, it was Lehman Brothers. In 2023, it was Silicon Valley Bank. From those bankruptcies to today, some companies still can't pay debts, default, or go bankrupt. Why these big bankruptcies? High interest rates. With high interest rates, costs are too high, people can't borrow, and can't pay interest. So, they let things go bad and companies collapse. Okay, the biggest reason is that interest rates are too high. To save these companies, just lower the interest rates. Lowering rates solves the problem. Just lower them. Cutting rates cures all problems. That's the idea. And since there's an election next year, they're basically lowering rates. So that's settled. Today I spent time to talk to everyone about these meme stocks, banks, or these two banks in the news recently. But I still have to remind everyone these bank incidents or bankruptcy events. Even though right now it's like a cockroach, it's just that size, like a cockroach, easy to deal with, easy to handle, but I still want to remind everyone, always remind everyone, the current index is at a historic high, not a historic low. So as long as something a little strange happens, you have to remember, it's okay to be the first to run, just go ahead and make a move first. Maybe today you don't see negative news. In the past few days, positive news, right? Lots of good news, maybe an earnings report, or positive news, and then a new high. We've reminded, whenever you see a new high, you must take profits in batches. We've said over 800 times. You must take profits in batches. If the price drops, you can buy again. Money only counts as yours when it's in your pocket. If you haven't put it in your pocket, it's just paper wealth, not real. Understand? Taking profits when prices are high allows you to buy back when prices are low. No matter if the dip is caused by a disappointing earnings report, or if it's a technical or volume-based correction after a big run-up. No matter if the dip is due to things like the Trump-China trade war, or for reasons we don't even know yet, or so-called cockroach theory or rat theory. Whatever the reason, when prices fall, there will always be a time when the market comes down. When that happens, you need to make sure you have enough cash on hand. You need to position yourself when the time is right, otherwise, you'll be left with nothing. You have to know how to sell high first, so when the market is low, you'll have the chance to get in. So remember, something we've talked about repeatedly, from August and September until now, when the market is high, take profits, take profits, take profits. If you consistently take in profits, honestly, whether it's ZN Bank, Western Union, or the leading used car company Sands Holdings, even if they go bankrupt or collapse, it has nothing to do with you and doesn't affect you. Why? Because you've been taking profits at every high point. So, if the price drops and there's another good buying opportunity, we can reposition ourselves. That's a more reasonable approach, and this strategy is safer. Alright, the 10-year government bond yield dropped below 4%. Officials consistently moved in a dovish, rate-cutting direction, bringing it to 3.95%. The terminal rate is now 3.5%. 2 or more rate cuts are now expected. Some people are arguing the opposite, though. Who is this? Boyo. Good evening, Boyo. Good night to Faye and you. Regarding Buffett and early bank stocks, he's impressive. Some also mentioned, good night, Frank, that Fanhua and Flickr has similar situations. It wasn't specifically stated, but that's the idea. There are theories, like the one about a movie theater catching fire. The movie theater fire theory. I might not have time to explain it in detail today. Basically, the idea is that when a fire breaks out in a movie theater, people don't notice, they aren't alert to it. Then, when a little bit of smoke comes out, people just brush it off, so no one wants to leave. By the time the smoke gets thicker and the whole theater is on fire, everyone rushes for the exit. But at that point, the exit is just that small. So if you don't leave early, if you wait until the fire is raging, and you didn't run when there was just a little smoke, by the time the whole theater is on fire, even if you want to run, you can't get out because the exit is just that small. So it turns into people trampling and pushing each other. If you don't die inside the theater, you end up getting trampled to death on the way out. That's basically the idea. This is called the theater theory, or the burning theater theory. Sharing this as it came up earlier. The US dollar index dipped 0.09% today, still above its 50-day moving average. Regarding the international situation, I think both sides in the US-China trade war. Both sides are actually trying to ease the tense standoff between them. How so? Well, you can see that Bloomberg reported that the US Department of Commerce might extend the exemption on tariffs for imported auto parts from 2 years to 5 years. Of course, this would be a huge positive for the auto industry. The official announcement is expected this week, but as of now, there's no official news yet. This is just what Bloomberg has reported. And the second point? China responded to the rare earth panic narrative the US has been pushing. The world worries if China will control rare earth exports or stop exporting them. If that happens, the US could join other countries to resist China. So of course, China is also worried about being labeled in this way. That's why today, China came out to push back, saying, "No, we're not trying to create panic. We're just talking about export controls. We never said we would ban exports." They even expressed that they're still willing to negotiate with the US. So from this incident, we can see that even though China and the US are tough with each other, there is still a certain degree of goodwill between them. But will this goodwill last until the Xi-Trump meeting at the end of this month during APEC, or even until the second round of China-US trade talks on November 10th? We'll just have to wait and see. However, regardless of how their talks go, in the period before anything happens, almost half a month, or even up to a month, the market volatility index will be quite high. This is true for US, Hong Kong, and A shares in China, all the same. As I said, because we're at historical highs, not lows, even slightly strange news, or any sign the China-US trade war is heading negatively will make everyone very nervous. That's basically it, the concept of theater theory. Now, for S&P Global. Let's quickly look at this related follow-up. It says the tariff issue will cause $1.2 trillion in losses for American companies, and globally, companies will lose $1.2 trillion as well. But for 2/3 of these losses, the costs might be passed on to consumers, which means consumers may worry that prices will go up. Once prices rise, consumer spending will decline, and when consumer spending drops, companies' revenues and profits could also take a hit. And this won't just affect Chinese and American companies. Is this something companies or countries would want to see? From this, we can infer that during ongoing negotiations US-China trade war, both sides will probably try to move things in a positive direction. As for other geopolitical risks, like talks presidents Russia and US, Trump and Putin, they spent 2.5 hours talking. But did anything really come out of it? I don't think they achieved much. He said that in the next 2 weeks, the presidents of the two countries will meet in Budapest, Hungary, to discuss things like Ukraine and Tomahawk missiles, and so on. Anyway, just let them keep talking. I don't think anything significant will come out of it, but let them keep talking. Overall, it doesn't really help oil prices much either. Anyway, oil is still moving in a bearish direction. During today's session, it dropped another 0.68%. As for economic data, let me check if anything was released tonight. It looks like there wasn't any. Oh, it seems like tonight, none of the related data, like building permits, new housing starts, or industrial production, have been released either. But it's fine if nothing was released. Even without the data, we can still move forward in the dark. Not having the data isn't necessarily a bad thing. For now, just relying on the news to make some judgments is enough. As for earnings reports, tonight we have American Express, and next week there's Coca-Cola. What's more important is next week, although I, Teacher Jiang, won't be doing the live stream. Next week's earnings season is more significant because we'll gradually start to see some tech stocks reporting. Of course, companies like Texas Instruments, Netflix, Tesla, IBM UNH, Chipotle on Semiconductor, UPS, Google, AMD, and others will release their earnings one after another through the end of this month. So from mid-month to the end of the month, the earnings reports of major tech stocks will start to be released. So everyone, keep your eyes open and stay tuned. As of now, the outlook suggests that tech stocks are expected to perform quite well in the third quarter. But if they really do perform well, and it's already expected that they'll perform well, and there are expectations, this is called. This is what the market recognizes. Let me say it again. If the third quarter earnings reports for tech stocks are expected to be good, this is the direction the market both acknowledges and hopes for. After all, with stock prices and valuations this high right now, if your third quarter earnings don't look good, wouldn't that be hard to justify? So if the third quarter earnings are really strong, that's something the market sees as reasonable and acceptable. So when this kind of positive news comes out, and there are already expectations for the earnings, remember, when the good news is released and the price surges, it's best to sell and take profits first. It's the same for all stocks. When there's positive news or good earnings and the price surges, sell. If you don't sell, the price can open high and then drop. Sometimes, it opens high and falls. Just like yesterday, TSMC opened high and then dropped. After some volatility, it might even reach new highs. but the immediate reaction is to reflect positive earnings. Remember, when you see good earnings news, don't chase. The surge from earnings is for you to sell and take profits, not to chase. Now it's the third quarter. If you can handle listening, then try to listen. If you can't, then when it comes to trading, if you're not careful and make a wrong move, things might get tough for you later on. That's all I can say. Things will get tougher down the road. Remember, if you see a surge on good news, take some profits first. About Oracle, let's get started. Good evening, Kai Saw. Who is this? This is Minnie. Good evening, Minnie. Teacher, your voice is cutting in and out. Really? Try exiting and coming back in. Yes, you guys, exit and then come back in. Exit and re-enter to listen again and see if it gets better, okay? Magwa, Maliwa, good evening. Okay, try exiting and coming back in again. Sometimes it's just our internet connection, whether it's your mobile device or our company's network, when there are a lot of people online, or when Teacher Jiang is speaking too fast, sometimes the audio can't transmit in time, and it just goes beep beep beep. Just try refreshing a few more times, press F5 a few more times, and see if that helps. Some people are saying they don't have any issues, so let's just continue. If the connection is choppy, just exit and come back in. It's like jumping out and then back in. If you do it 3 or 4 times, it should feel normal. That's pretty much how it works. Alright, now for the Oracle part. At the AI World Conference, Oracle mentioned that if there were an AI facility with a total revenue of $60 billion over 6 years, the gross margin could theoretically reach as high as 35%, not just the 15% that the market is worried about. So he said that 35% is actually pretty good. Right now, Oracle has as much as $500 billion in backlogged orders. By 2030, which is 5 years from now, they said that by 2030, Oracle's AI data revenue could grow nearly tenfold from this year's $2.4 billion to as much as $20 billion. Overall, by 2030, the company's total revenue will be $225 billion. A lot. All of this is positive news. This revenue growth, or a 35% profit margin, will definitely ease market concerns. One last thing he mentioned, something everyone can keep an eye on going forward. It's not about saying revenue 50 or 60 billion. Every company dreams big. Your revenue reach those numbers in 5 years? Nobody knows. He's saying, based on their company's financial model, they can project 2 billion, or even budget for 200 billion in the next 5 years. But that's their estimate. But nobody knows what might happen in the next 5 years. Maybe AI development suddenly doesn't go well, or maybe some companies in the capital expenditure chain go bankrupt or the supply chain breaks. So, whether you can actually reach those numbers in the future, nobody knows. But there is one thing we can observe. He announced this AI factory plan to help companies accelerate their adoption of AI technology. I actually find this pretty interesting, because right now, a lot of companies don't know how to use AI. They know AI is booming, and they know it costs a lot of money. But first of all, they can't afford to spend that much money. They don't have $30 billion or $50 billion to develop this AI. So all they can do is rent this equipment, or use subscriptions, like Gemini, Anthropic, and so on, through these model platforms. They collaborate, or they rent the relevant computing equipment from the 4 major CSP providers to develop their company's AI. That's all true. But as you develop, you'll always run into natural obstacles. Maybe you'll hit some bottlenecks, whether it's performance bottlenecks or architectural bottlenecks in development. So at this point, Oracle says they're launching what they call the AI Factory program, which is to help businesses figure out how to quickly and truly use AI technology to make money. Now, I think this is interesting. You can imagine it. Let's talk about this. We always have a simple example. Back in the day, whether it was during the Japanese colonial period or the early years of the Republic of China, up in northern Taiwan, wasn't there Jingguashi, Jiufen, Jingguashi, Ruifang? Weren't there mining operations over there? Back then, mining boomed. Gold mining, coal mining, all of it popular. NVIDIA was the company selling electric drills. They sold electric drills, and whether you were drilling for coal, gold, or any mine, you needed NVIDIA provided. Their electric drills were easy to use, powerful, and increased mining output. Alright, with NVIDIA, it doesn't matter what mine you're running or what you're doing. Anything AI-related needs NVIDIA's chips. NVIDIA basically specializes in selling drills, shovels, and tools. So whether your mining operation succeeds or fails, whether your mining business makes money or not, you still need NVIDIA. For NVIDIA, it's basically a guaranteed win. This is the first thing. So what does Oracle do now? Oracle basically teaches you how to use these tools. Let's say today, there are all kinds of gold rushers. Some want to dig for gold, some for coal, some for all sorts of weird things. There are a lot of people wanting to mine different resources because the industry is booming, but they don't really know how to use the drills, the shovels, or the pickaxes. So what does Oracle do? Oracle teaches you how to use all this equipment. What do they teach you? They teach you how to use that drill to dig up the coal you want, or to mine the gold you're after. Basically, what Oracle wants to do in the future is this. A lot of people know they need to go to NVIDIA to buy the equipment, but they don't really know how to use it effectively. If you learn the skills and know how to make the most of these shovels, pickaxes, and bricks, these tools, won't you be able to dig up the coal, gold, or whatever resource you want much more smoothly? Oracle is teaching you how to use these tools. That's why I think this is their highlight. If they can really pull this off, NVIDIA sells the shovels. Oracle teaches you how to mine. If that works out, this positive cycle will make it much easier for many companies to thrive. So, I think at this Oracle AI World Conference, this is the real highlight. All that other stuff about revenue is secondary. I think it's fine to listen and move on. As for Oracle's stock price, it spiked during trading yesterday. Whether it keeps going up today or drops back to the 20-day moving average, we can't say. In the short term, it went up 3.09% yesterday. For short-term support, keep an eye on the monthly moving average. Even if it falls below that, there's support at the neckline and the 50-day moving average. Overall, it's leaning toward a bullish trend. It's just that it's sticking pretty closely to the 20-day moving average, kind of in a tug-of-war. Let's see what else gets mentioned during these 4 days of the AI conference. Just keep an eye on it, okay? Don't go chasing it, really, don't chase it. Now, let's take a look at Meta's ups and downs. You know, people aren't just about ups and downs. There's happiness and worry and happiness, right? There's a lot that's gone wrong again. So what's the good part? The good part is that the world's largest eyewear group, this company's name is really long. I think it's either an Italian or French company. Something like Essilor Luxottica, or something like that. Anyway, the name is hard to pronounce. I don't even know how to say it. This company is very famous because it's one of the most important companies in the world for making sunglasses. If I mention one of their product brands, you'll know it, Ray-Ban. Ray-Ban sunglasses are made by them. They're the ones who make them. Today, they released their financial report and said that their third quarter revenue increased by 11% year over year, reaching nearly 6.9 billion euros. They also have a partnership with Meta. In fact, those AI smart glasses, they're small, really handy, and selling very well. Right now, the best-selling smart glasses in the world are the Meta Ray-Ban smart sunglasses. Those smart glasses account for the majority of the global smart glasses market. They have over 75% market share. If I remember correctly, it's not below 70, it's as high as 78%. More than 70%, almost 80%, is Meta. These AI glasses are selling like crazy. Apple has also said they want to move in that direction in the future. So of course, this also means that Meta's development of these AI glasses gets a boost, because they're selling so well. With such strong sales, it's definitely helping their revenue. But what's the negative news? It's about the former Deputy Prime Minister of the UK. This deputy named Nick. So why did Nick bring this up? Because he once served as Meta's internal policy chief, which is pretty impressive. He was a Meta executive, and then went on to become the UK's Deputy Prime Minister. He's issuing a warning. He's warning that the probability of a correction in current AI stock prices is very high. He said that the AI wave is causing company valuations to be too high. As for the bubble, he believes it definitely exists. It's just a matter of when it will burst. No one knows when it will pop, but he says the probability is very high. But even if the bubble bursts, it doesn't mean the AI wave will fade away. What he means is that right now, a lot of companies are just jumping on the AI bandwagon, constantly increasing capital expenditures, making grandiose claims, and selling big dreams. The bigger your dream, the bigger you make it sound, and they talk it up to the skies. As long as you have anything to do with AI, it seems like your stock price will go up. So there are a lot of things about this that people criticize. Of course, there's a lot of room for imagination. But because valuations are too high, when your revenue and profits can't keep up, the bubble will burst. So what he's saying is that AI has caused stock valuations to become too high, and this bubble will eventually burst. But because AI really does exist, and there is a real need for it, and the demand is truly that big, the future trend is still moving toward AI, not away from it. So even if this bubble bursts, the demand for AI will still be there, and this wave won't just fade away. That's why he suggests that investors should pay attention to what? To observe each company, each business, and their actual business operation models. Whether it's sustainable or feasible, instead of just listening to them talk about big dreams and how amazing everything is, then getting overly idealistic and chasing their stock prices. This is hard for most people to actually do. If people could really do it, they wouldn't just be swayed by some business owners hyping things up, saying, wow, with my AI development, I can use AI to pick stocks and invest, and every stock I pick is a winner. Invest in AI, invest in stock selection, and today I picked this one. This AI, like AI apples or AI pork belly, using AI to pick pork belly with highest nutritional value. Apples worth 600 times more than kiwis, the idea they're selling. As you listen, you can't discern what's real and what's fake. Some might tell you AI can catch cockroaches or kill rats. So after a while, this kind of thing just turns into a bubble. That's why this former Meta executive is telling everyone that there's a high chance AI will become a bubble in the future. But if you want to look for AI companies, that's fine, because this wave isn't going to end. It might burst, but it won't end because there's real, tangible demand for it. So what you need to look for are companies that are genuinely serious about developing AI, and that actually have real cash flow coming in. Their vision is more solid, unlike those companies that are just making empty promises. Oh, many companies make empty promises, but many also truly work hard to build the AI industry. If you look closely, as we discussed often in our group's evening program, there are many good companies out there. So about Meta's stock price? Be cautious with Meta, just be careful. Recently, how is its stock price? Among the Magnificent Seven, it's like AI soy milk. Yesterday, someone mentioned it, AI tofu. Honestly, I don't get it. What soy milk or tofu have to do with AI? I really don't get it, I just don't. If you have AI soy milk, AI tofu, or even AI apples, are they actually tastier? How is that any different from a potato picked by a computer? It's the same thing. And then, there's that canned food, right? Isn't that just like those canned foods with a fancy name? You might as well just buy that. Why would I need AI to help me pick it? There's really no need. So I feel like a lot of this is just people trying to jump on the bandwagon, trying to hype things up. But honestly, I think it's all pretty empty, really exaggerated. There isn't any real market demand for it. People just want to. You have to keep your eyes open and act fast, and really see clearly which companies are just messing around, and which ones are actually running their business well. Looking back at Meta, of course, their revenue and profits aren't really a problem, but you do need to pay a bit of attention to their valuation. Meta is one of the so-called Magnificent Seven. It's one of the few whose stock price shows a pullback technically. The 50-day and 20-day moving averages are curving downward. They're turning down, while many other companies still trend up. Google, for example, is still moving upward. Google's chart, and even Tesla and Apple, which have risen a lot, are still catching up and moving higher. Microsoft's moving averages are at most flattening out. But two companies need special attention, Meta and Amazon. For these two, their stock prices moving averages recently started to trend downward. In the short term, pressure this pullback strong. This neckline, kind of holding, kind of not. Blue line sometimes holds, sometimes doesn't. Pay close attention. If the neckline can't hold, if it drops further, the next correction is the 200-day moving average. Alright, if it corrects downward, the next support is the 200-day moving average. Why? Because right now, two short-term resistance levels above, 50 and 20-day moving averages, are sloping downwards. If trending upwards, different. That makes sense. According to Granville's 8 rules, when the moving average trends upward, it acts as support. But when it slopes downward, it becomes overhead resistance. So pay attention, Meta is different here. Both its moving averages trend downward. The key is whether this neckline can hold. If it cannot stay above and drops further, it could correct all the way down to the 200-day moving average, so be cautious. Fundamentally, no major concerns. Honestly, no big worries. The technical correction might lose momentum, so it's worth keeping an eye on. Alright, moving to the stock market pre-market. Chester Financial's pre-market shares are up 4.89%. O'Reilly Automotive is up 0.92%, and CSX Corporation is up 2%. More companies declining. As for gainers, Consumer staples like Coca-Cola and Ball Corporation are up 1%. Eli Lilly is declining. Why did Eli Lilly's stock go down? Trump wants to lower profit margins on weight loss drugs, so both Novo Nordisk and Eli Lilly saw their stock prices drop. Eli Lilly was down 4.6% in pre-market trading, which is quite a lot, even more than Oracle, which was down 4% pre-market. Inside, Albemarle, Bitcoin-related companies like Coinbase and Robinhood, and even Intel, Micron, and AMD all had significant pre-market declines as well. They dropped 2 to 3%, mainly because everyone is worried. With a little trouble, banks could have bad debts, and the auto industry could see bankruptcies. Could this snowball into another Silicon Valley Bank collapse, or even something like the 2008 Lehman Brothers crisis? Let me tell you, these are still isolated cases for now, and honestly, the impact isn't significant. The effect isn't big, plus there's an election next year, so the US government will step in to handle things. So you can treat this as short-term volatility or negative news. But after this wave passes, what then? If you have extra cash, think the other way around. Are there any stocks unfairly beaten down, or any you've been wanting to buy that just dropped recently, especially today? Are there good buying opportunities? That's what you should be thinking about instead. Instead of just following the crowd and selling good stocks for no reason, some are quality stocks. If some stocks have gone up too much, you should have sold them earlier. Don't wait until today, selling just because of this bank bad debt issue. That's too late. As for the Dow Jones Index, today we need to watch the 50-day moving average to see if it can hold. The Philadelphia Semiconductor Index is doing pretty well. At least it's holding above the monthly moving average, so it's fairly strong. The Magnificent 7 Index dipped slightly by 0.4% yesterday. Let's watch support at the 50-day moving average. The downward pressure is heavier due to low interest rates. Most major financials are moving. Yeah, most of the major declines are coming from the big tech giants, with drops ranging from about 2% to 4%. So today, pay a bit more attention to position management, capital allocation, and even stock selection. You really need to be extra cautious. Remember that saying, when prices surge, take profits. When there's a sharp drop, check for quality stocks unfairly beaten down. Opportunities might exist for bargains. That's all for now. Tonight's show brings latest updates before the US stock market opens. After class, like, subscribe, and share. Finally, I wish everyone smooth trading. See you next week.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.